A master facility is a pre-approved credit limit used for equipment finance, such as cars, trucks, trailers, earth moving, manufacturing equipment. It's set up on a 12-month annual review basis. The benefit of using QPF for a master facility is we will set that up away from your main banking relationship. It's really important to spread your risk amongst multiple lenders. Basically, any business looking to map out their next 12 months CapEx expenditure. It might be to upgrade a current car fleet, it might be a hire company who hires out yellow goods such as excavators, bobcats and the like, or what we're seeing a huge increase in demand at the moment is for manufacturing equipment. It's usually a long lead time, whether it's coming from overseas or a local distributor. They have to place those orders 6 to 12 months in advance. At least they can do that with confidence, knowing that they've got the funds available for when that machine arrives. The benefits will vary from client to client, but the most common feedback we receive is that peace of mind. They're able to go to market, plan their future, knowing that they have those funds available to draw down when the machine arrives or the equipment is ready for dispatch. As business owners, we're typically quite time poor. Since the new banking code of practice and more recently the pandemic, I think we can all agree that banks are taking much longer to simply approve an application or go through their ID process. Some lenders 3 years ago were taking 24 hours to do the entire process from start to finish. That's now blown out to 8 days in some instances. By doing a pre-approved master facility, we do all of that up front. So each time you need to draw down, it can be as little as a 24-hour turnaround. Whether you are applying for $500,000 or $5 million, that amount will be undisclosed on your credit file. The main benefit of that is it won't impact further styles of lending for either your personal or business use. What happens when your bank says no? You've been using your bank for 25, 30 years, for all of your banking products, for all of your lending, and you think you're building this great relationship. But unfortunately, at some point, banks have to cut off a level of credit, and at that point, it becomes really difficult to establish a line of credit elsewhere. It's much more practical to establish a master facility before you get to that point, utilising multiple banks and ensuring that your business can grow. By this stage, it could be too late to seek a funding line elsewhere. It's incredibly important to keep your options open so that your business growth is not hindered. Historically, we've seen our clients utilise our master agreements, and on the rare occasion that they may be capped with that bank or multiple banks that we establish those relationships, they're able to return to their main bank, who often hold security over commercial or residential property, maybe a security over the business. The beauty of our master agreements is we only take security over the equipment that is drawn down under that facility. Most clients aren't aware that their bank will intertwine all of their assets and banking products. Worse still, they'll often include an all monies clause. An all monies clause is often undisclosed. It gives the bank the ability to call in your debt at any time. If they sense that your business is in distress, we have a slight downturn in trading, they're able to call in all of that debt at any point without cause. This is why I'm a big advocate for spreading your banking risk.